Exchange outflows have surged to unprecedented levels, eclipsing even the peaks seen before bull market runs. When traders withdraw vast amounts of cryptocurrency, whether Bitcoin, Ethereum, or others, from centralized exchanges, past patterns have shown two opposite outcomes: a breathtaking rally or a devastating collapse. As of mid-August 2025, outflows are reaching record territory, prompting investors and analysts to reassess market dynamics and intentions. In this video, we'll analyze the data, explore possible catalysts, learn from historical cycles, and consider what may lie ahead amid this extreme withdrawal surge. The video is going to be interesting, so make sure to subscribe to the channel and hit the bell icon for more future updates. Let's get into the video. The numbers. What makes these outflows record high? Recent weeks have seen exchange outflows, net withdrawals of crypto from centralized trading platforms, soaring past levels seen even during the 2020 to 2021 pre-bull run era. On-chain analytics firms report that the volume of such outflows has broken prior all-time highs, both in absolute amounts and relative to exchange supply. These massive withdrawals suggest that far more crypto is being moved into cold wallets or self-custody solutions rather than circulating on exchanges for trading, or worst, sudden dumping. The magnitude and breadth are extraordinary. This isn't just a move in one asset, it's a cross-market phenomenon that indicates something more systemic is happening. Rally or crash? What patterns history shows us? Historical precedent paints a dual image. In prior cycles, massive outflows in Bitcoin and other cryptocurrencies have often preceded both explosive rallies and brutal corrections. For example, in the spring of 2021, exchange balances dropped significantly while prices surged. Buyers were hoarding off exchanges, reducing sell pressure, fueling the bull run that followed. Conversely, other periods of heavy outflows preceded sharp declines. When sentiment soured, large holders began pulling assets before dumping them, causing cascading sell-offs. The contrasting outcomes hinge on key contextual factors, including on-chain sentiment, macro market conditions, and overall liquidity levels. Possible catalysts behind current massive outflows. Several drivers may be underlying the current record outflows. Institutional accumulation. Growing adoption by institutions may be prompting large custodial transfers off exchanges into secure vaults, signaling long-term bullish conviction. Regulatory fears or rumors. Heightened regulatory scrutiny or speculation, particularly from key markets, could be prompting preemptive withdrawals to avoid potential freezes or restrictions. Decentralized finance, DeFi, yield opportunities. Attractive DeFi yields may lure funds off exchanges into staking, yield farms, or liquidity pools, reducing the on-exchange supply. Anticipation of tax or policy changes. In some jurisdictions, looming tax reports or policy shifts could motivate traders to transfer holdings into private wallets for better control. Concerns over exchange stability. Memories of past exchange failures, e.g. FTX, may continue driving risk-averse investors to favor self-custody, especially when volatility heightens. These catalysts vary in strength and clarity, but together they help explain why such large quantities are showing movement away from exchanges at this time. On-chain insights, interpreting intent or speculation. On-chain data doesn't just quantify outflows, it also offers qualitative clues. Tracking the destination of withdrawn funds can hint at intent. If funds move into long-term cold storage, that often aligns with accumulation. If they move into contract addresses tied to DeFi protocols or staking platforms, that suggests yield-seeking behavior. Conversely, movement toward known deposit or mixing addresses may indicate preparation for sale or distribution. Early analysis suggests a substantial share of recent outflows are earmarked for cold wallets and certified vaults, but a meaningful portion is also streaming into staking and DeFi channels. That mix suggests a blend of long-term hodling and active deployment into yield strategies. Ecosystem liquidity. How outflows change market dynamics. Centralized exchanges are prime hubs of liquidity. When large sums depart, they shrink the pool of immediately tradable assets, potentially increasing volatility. With draining supply on exchanges, even relatively modest orders can exert outsized influence on prices. If supply shrinks, while demand remains steady or grows, upward pressure on price intensifies. On the flip side, low exchange supply can also foster panic selling, If traders believe liquidity is drying up, they may preemptively sell before others do, even triggering cascades. Moreover, with less liquidity, the market becomes more sensitive to leverage-driven liquidations or algorithmic trades. In essence, record outflows reduce stability while amplifying the force of price moves, whatever direction they're headed. The road ahead? Rally, crash, or something else? We stand at a pivotal juncture, with exchange outflows hitting unprecedented levels. The weight of historical precedent suggests that such events can precede both stunning rallies and painful collapses. What matters now is context, including where flows end up, prevailing sentiment, macroeconomic undercurrents, and policy developments. For now, there are bullish signals: accumulation, long-term custody, DeFi deployment, but also cautionary signs: liquidity drain, fragile stability. And here we have it. If you enjoyed this video, don't forget to like, share, and subscribe for more content like this. Thank you for watching. Have a wonderful day.